Guys, next Thursday at 1 p.m. Eastern Time, I'm doing a very special class. It's called the 10 Times Challenge. Let me explain to you why it's so important and it's so special. Usually, I give a trader a system or I talk about how to make money. But in this situation, in this class, I'm going to give you a 3-year plan to make 10 times your money. Yes, a full 3-year plan, step by step. I'm going to lay it all out on the line to help you become a better trader. But not just a better trader for the next 3 months or 6 months, but for the next 3 years. So it's going to be a very special class. It's going to be on the 11th of April. It's going to be a Thursday. It's going to be 1 p.m. Don't miss out. 10 times challenge. Register below this video, okay? You need to be there. This is going to be the best class yet. Now, to give you a little taste, I'm going to give you right now 3 things that I do every day. And these 3 things have become part of me. I do this every morning that markets are open, and it gives me a very, very good idea of what I'm going to expect for the rest of the day. If you don't do this, you're going into the market blind. So the first thing I do is I look, just switch this, I look at global markets. All right? Global markets. What I do and why I look at global markets, because the US stock market does not trade in a vacuum, okay? Markets are related. Currencies, interest rates, bonds, global economy, it's all related. The number one factor that moves the US market is not Microsoft or Apple or Amazon. It's global economy. China can move the global markets big, and that'll have a major impact on US markets. Britain can move the market really big, because these things move currencies, and the currencies market is about 100 times, maybe 1,000 times, yes, about 1,000 times bigger than the stock market. It's massive. A lot of you don't realize that, but the currency market is what causes the US market to fluctuate. So global markets, we want to get the lowdown on global markets. We want to know what happened to China, what happened to Britain. We want to see how the markets traded overnight. The major indices, China, Japan, and Britain and Europe, okay? We need to know that. If we don't know that, we're lost. Because the US stock market's going to open based on how those markets close. So, what's the first thing we look at? We don't look at the stock market. We look at the E-mini S&P. We look at the S&P futures. Excuse my writing, it's terrible, if you can make any sense, but we look at the S&P 500 futures. These S&P futures trade almost around the clock, and they give us a really good anticipation of where the stock market's going to open in the morning. So if you look at the futures about 20 minutes before the opening bell, you'll have a really, really good idea of where stocks are going to open, and that's going to help you with your analysis. So if you're a swing trader or a day trader or a really short-term trader, you got to look at the S&P 500. It's very, very important, and it's relevant, and that way you'll avoid all surprises. Also, here's a tip. If you see the S&P futures are sharply up and you want to get in on a stock, the stock market's probably going to open higher, substantially higher. So you may want to wait and enter your order later. So this is an amazing guide to help us correlate orders, to give us an idea if there's going to be a gap in the morning. If we want to pull our stops out till the market settles down, this is what will give us that clue. So we start with the global markets, and then we'll move on to the S&P Future 500 markets. And again, they trade literally overnight. You can turn on Bloomberg 20 minutes before the opening bell, CNBC, and you'll see S&P Futures there. It's everywhere. Bar charts, stock charts, any news broadcast, even Yahoo has them. So you shouldn't have a problem with that. And lastly, the third thing I look at is bond futures. Bond futures should be, and I'll explain to you why I look at bond futures. And I'm looking at the 10-year or the 30-year future contract T-bond and T-note. That's the 30-year and that's the 10-year, okay? 30 and 10. And the reason we look at bond futures is bonds trade inverse to the stock market. So if there's a big report or a huge news article or something impacting global economy, We want to see how it's going to impact the bond market to make sure that the bond market is not out of whack with the stock market. So in other words, if stocks are down 200 points on the Dow and you see the bonds are up 3 ticks, that's not that. That means that the stock market is out of whack, okay? That means there's a company or something that's impacting the stock market and it shouldn't impact it for too long. For example, let me give you a good example. When Boeing had the incident with the airplanes and the stock opened down 30 points, that had a major influence on the stock market, but only for a few days. So the stock market was out of whack with the bond market. And you'll usually see for every 100 points that the Dow Jones moves one way or the other, that the 10-year note will move about half a basis point, which is about 16 ticks. And those are the 3 things that I look at when I trade financial markets. You want to start your morning with it. Again, let me just give it to you again. Global markets, S&P 500, that looks like a B, but it's a P, and T-bonds. Or T-notes, it really doesn't matter, they're correlated 99%. I hope that helped. If you start with these practices, you'll be on a good plan to analyze the markets the right way with a top-down approach. Talk to you soon. Thursday is my 10 times challenge class. I'm going fully into detail on everything it takes to be a successful trader. My goal is for you to literally multiply your portfolio tenfold. Click below and make sure to reserve your seat. I'm laying out a full 3-year plan for you to become a dominant trader and completely transform your life. Yes, transform your life. Make sure to save your seat today. Follow the link below to sign up immediately.